In this video, I'm going to discuss life insurance that builds cash value and how to leverage specific plans to help out with your retirement goal or just overall situation, and then how to make sure you're not placing your monies in the wrong area or the wrong type of product if you're not trying to accomplish a max cash value build and more towards a max death benefit build. So the key takeaway throughout this entire video is understanding how a permanent life insurance product can be leveraged as a max death benefit build versus a max cash value build, and then seeing whether or not it makes mathematical sense to go along with a specific product, making sure that you're not, or a specific policy, making sure that you're not falling victim to the most common mistakes. So up on the screen, I have a type of illustration showing you the concept of how a max death benefit plan works, and then I'm going to make some tweaks to it and showing you how somebody could leverage it towards a max cash value play. So what I mean by that is, let's say if you have an individual and they want to have $500,000 of permanent life insurance, and they understand that the cost is $1,000 per month, or let's say per year, the monies that go into this type of plan, majority of it is going to be eaten up by cost of insurance and other expenses. This is the risk to the insurance company. So as an example, when somebody is going and they're trying to place monies initially into a plan, the largest risk is going to be on the insurance company, especially in those first couple of years, because of this. Let's say this person pays one premium payment and then passes away, the insurance company now has to pay out $500,000 to the beneficiaries of that, of that insurance plan. So there's going to be a lot of cost of insurance and other expenses, wrapped up into the first couple of years of this plan. And then as it keeps progressing further and further, then this could start to alleviate. But just be mindful of this concept. Somebody's putting in $1,000. The bulk of these monies are going towards the cost of insurance and other expenses to take care of the risk to the insurance company, and you have a very small portion is going into a type of savings account component known as cash value. It's kind of like building equity in a home. What's happening is you're building equity within that type of policy. So if you have a high death benefit, obviously that means a higher risk to the insurance company, and that's going to translate to higher costs and other expenses to the individual, saying this $1,000, majority of it's being eaten up, and then only a small portion of it is going towards that cash value component. So a simple way, and be mindful, this is just a concept. I'm going to go more into the details off of how to really leverage it for your situation, making sure you're not falling victim to common mistakes. But in this example, the same $1,000 is going into a policy. Instead of a $500,000 death benefit, there's a reduction of a $200,000 death benefit. So therefore, there's less risk to the insurance company's books, and therefore less risk, less cost of insurance and other expenses that would come into play, and more money's into that savings component, the more money's going into the equity component of the policy known as the cash value. And ultimately what happened was it reduced the death benefit, which in turn reduced something known as NAR, net amount at risk. So now just to jump back, if somebody really wants to maximize the death benefit and they don't care about cash value, then they should be going into a plan that has more cost of insurance and other expenses that are more related to that death benefit. And they have plans available that really maximize this. And you might not have any sort of cash value in there. And you have these guaranteed death benefit related riders that are associated in there. So you're saying, okay, if I'm putting my $1,000 in there, I want to make sure that till the day I pass away, 500 grand is going to go to my beneficiaries. That's the only important aspect. So for the other individual that says, okay, I want to leverage the benefits of a cash value life insurance policy, and the reason would be because they want to receive some sort of tax-free growth within this cash value component. They want to receive some tax-free income if they're taking distributions out properly. Receive some sort of tax-free death benefit would go to beneficiaries, and then also they could leverage some tax-free ancillary benefits such as leveraging their plan as a living benefit for the cost of long-term care or disability and different things like that. So that's where they would try to structure, one of these types of plans, just reduce that net amount at risk, place the monies in there. The bulk would be going to the cash value, and the less amount would be going into cost of insurance and other expenses. If someone really wants to push the pedal to the metal, this is where we try to structure plans, and it's known as a max cash value type strategy. And all we're doing is we're not only reducing the death benefit even further, we're reducing the net amount at risk even lower. So what we're doing is we're trying to cherry pick the best carriers available that have the cheapest amount of cost with this sort of plan, and based upon that individual's age, based upon the time horizon, what sort of benefits, what sort of expense reimbursements could also come into play to make sure that this cash value is being maximized that much further. So, just be mindful. The concept is, how do we lower net amount at risk as much as possible? But then there's a lot of other nuances in there. So there might be, on average, about 100 to 110 different carriers that offer these types of cash value plans. Out of those carriers, you might only have 2, 3, maybe 4 that could be really good and could really set up a nice cash value maximization play, while the over 99% of the other carriers are complete dog shit. Excuse my language, but it would just put you in a lot worse of a situation. So don't always go for the shiny object. Be mindful that there are little tricks, little tweaks that you can make to really maximize, how to leverage this properly. So just like how I explained my other videos, where I say, conceptually think of an account like a bucket. A bucket grows by the contribution that somebody's making into the plan and the rate of return that's coming back. If you have the least amount of costs that are going into the plan, like this, saying, okay, the least amount is going to be eaten up with the cost of insurance and other expenses, that means the most amount of monies of this $1,000 in this example is going to be dumping into this cash value component. Now, what distinguishes one cash value type of plan over another is what type of permanent life insurance policy that individual has. So the formula goes by, if you're reducing the net amount at risk, obviously you can add further contributions, further net amount of contributions into this cash value bucket. But the other side of the coin, which is typically overlooked, is this rate of return. And what determines this rate of return is based upon what sort of policy that this individual has. So if they're trying to get more of a fixed interest rate, this is a type of whole life insurance contract. So you might have a good whole life insurance contract, or carrier would be offering a favorable dividend. Also, when you're trying to pull monies from those types of plans, you have non-direct recognition, direct recognition companies allowing you to pull out loans from the policy and still be able to arbitrage your cash value in the process. So, there's some nice little nuances there. But if somebody says, I don't really care about, the ebbing and flowing of this type of account, I just want to have a safe, consistent rate of return in there, that's where they would look more towards a whole life insurance plan for that cash value maximization play. The other side, which was more popular in the early 80s, is something known as universal life, and this is where it was tied to interest rates. These plans still exist, but be mindful that they're very minimal interest rate because interest rates have dropped to all-time lows. They're no longer paying those double-digit rates of return, and a lot of those old-fashioned policies are known as blowing up. So if you have an old-fashioned universal life policy, you have to be very careful. Feel free to give us a call of our 1-800 number and ask to speak to a specialist, because that's something that you're not going to want to hold on for a long time, and then therefore realize, okay, your policy might blow up and you're going to have to come to the table with significantly more premiums than what you were paying throughout the life of your policy. So this is more tied to interest rates. You have the third type is a variable, which is tied to mutual funds known as sub-accounts. What that means is the rate of return is going to be variable. It could either be positive or it could be negative. If, let's say, you have negative rates of return, first off, these mutual funds and these different types of funds that are associated in there could be very expensive. These sub-accounts could be very expensive. So that's obviously a pressure against this type of bucket. And then anytime there's a negative, it's equivalent to someone taking a sword and slicing this bucket. So you want to be very careful with the variable universal life plans. And then lastly, a very effective strategy that someone could leverage is something known as an IUL, an indexed universal life, which it depends upon the type of carrier that you're with, but some carriers allow you to have uncapped indexing strategies on this, so you could have a nice double-digit return in a given year. Or worst case scenario, if the market goes down, you're going to have a 0% rate of return off of this, rate of return side. So as long as you're controlling how much net amount at risk is being set up in this type of plan, and you know that there's contributions being added to this bucket, that's obviously going to be increasing the cash value. But then whenever the cash value increases further with an index that's related to this, to the growth of this account, to the rate of return, whenever that comes back favorable, you'll obviously have that double compound interest working in your favor. Also, there's flexibility that if you ever need to reduce the amount of death benefit or reduce the amount of net amount at risk, or pull out monies from that, you have different arbitrage opportunities that could be more beneficial than the other ones mentioned. The whole life, the universal life, or the mutual, or the variable universal life. So be mindful of the difference between this, because if somebody's saying, hey, I want to make sure that unequivocally I have $1 million or $500,000 that is going to, or $2 million, whatever that number is, that's going to my beneficiaries, I want to leave this as some sort of legacy play, they should not be leveraging a max cash value strategy. They should try to leverage a max death benefit strategy. Yes, because this is tied within the house of life insurance, there's always going to be some sort of death benefit that's sitting there, and you want to make sure that you're staying within, it's known as Internal Revenue Code 7702. So you might have heard of 101A plans or 7702 plans. All that is a type of max cash value strategy, and what that means is you have to have at least a minimal death benefit that's sitting there. You can't just have $1 of death benefit, or else it would result in a MEC, a modified endowment contract. So you want to set up a plan that has a non-MEC related limit, so that your death benefit and cash value is correlated. As your death benefit is increasing, it's staying within the cash value corridor, your cash value is increasing. So, or as your cash value is increasing, the death benefit's increasing. If your cash value is going down, you want to make sure your death benefit is going down, so that these are as close to each other as possible, and that net amount at risk is as close to each other as possible. Now, why would you put yourself through all that, headache? It would be because of the benefits that you could get out of these types of plans and out of this type of strategy. And the benefits really come down to tax benefits. From a growth play, there's a way on how your cash value could grow tax-free. So you have the power of compound interest that keeps, compounding within that sort of plan when it's properly structured, and then you're having that maxed out growth, and all that growth is coming out, is basically growing the policy tax-free. So it's not as if you're in a brokerage account that anytime there's a buying or selling of a position or a reallocation change, that there's going to be some sort of taxable event, and it could stunt that sort of compound interest play and really allow you to have some exponential growth in there. So that's where it's almost growing in a tax deferred chassis, except for it's growing in a tax free chassis, similar to like how a Roth IRA account type, a concept type works. The next thing is income. So there's ways on how you could supplement, if you're looking for it as a retirement play, you could leverage this as a type of retirement supplement. So let's say if you have Social Security income, you have pension income, you're leveraging annuity income, and you want to have another slew of income streams coming there. If you don't want to leverage other types of assets, you want to receive some sort of tax-free income, there's different strategies on how you could set that up properly. There is a death benefit still there, and that death benefit, does go to beneficiaries tax-free when structured properly, and then also ancillary benefits, and that's something that more recently came out. More recently, I'd say early 2000s, about 2010, 2015, where you have these long-term care, these living benefit options that you could tie into the policy that they don't have it for an additional cost. So it depends upon the carrier, it depends on the on really what sort of plan you're trying to go with. Sometimes there's a charge for it, and it might not make mathematical sense to do it. Other times you could have that built into that sort of plan with the correct carrier based upon your age, based upon that time horizon that you're trying to grow it. And these are really the 7 most important things that you should be mindful of if you're looking for a life insurance policy that builds cash value. The number one thing is you have to leverage an advisor that knows how to utilize these things. You can't just go to any Tom, Dick, or Harry, somebody that just got their life insurance license, and they're trying to tell you all these great benefits of, it's going to give you tax-free growth and tax-free income and tax-free death benefit and ancillary benefits and all these, rainbows and butterflies, because there's a lot of bullshit out there. And there's the incentive of these types of plans are agent commissions. So if structured the wrong way, and you have too much money going towards the cost of insurance and the expenses that could eliminate the cash value growth within that plan, the reason why an advisor or a life insurance agent might be trying to sell it to you would be for that large commission that they could make when it's improperly structured. So be very careful with how you do that. Like with my company, we make sure we have an entire division that leverages these cash value plans, and that is all that they do. It is their bread and butter. They make sure that they're going through every little concept, every little detail of the person's age to how much money they want to place into the policy, on if they want to leverage further components with this policy to see, okay, mathematically, does it make sense to even utilize this type of account, or would it be more hassle than what it's worth? So that's where the advisor is very important, making sure that you're going with a competent advisor that knows how to structure these things. The other important aspect is the right company. Don't just go with a fly-by-night company. Like you have a multi-level marketing company that's doing this right now, and they bring on a lot of volume, all because you might have a top company that sells a lot of IUL policies or whole life policies, just cash value policies in general. That doesn't mean it's a good company and that's a company that you should go with. There's little sweet spots with everything, just like annuity plans, just like investment-related plans. There's sweet spots, and each individual situation is different. Somebody that's in their 20s that has a 30, 40-year time horizon could be set up with company ABC, and that would be the best solution, versus somebody's in their 40s and they only have 10, 20 years left from retirement. That could be company XYZ could be the top one, versus somebody in their 60s. It might the sort of cash value play and this sort of cash value strategy might not be beneficial to that person that's much older, because they might not give themselves a long time horizon before they're trying to really access and utilize utilize this plan or utilize this sort of concept correctly. The product is very important. Do you feel as if the market's going to be growing favorably and you don't care about the ebbs and flows? Are you fine with a variable related account, or do you like more of the comfort of knowing, okay, I could have a decent rate of return with no downward market losses, where an index or an IUL would be better, or you just want to have safety, you want to have some sort of fixed rate of return with the company's dividend, and that would be a whole life insurance carrier? Or do you feel as if interest rates are going to skyrocket and you want to leverage that sort of bandwagon with a universal life? So there's a lot of different nuances to this, and it's about obviously the correct advisor, correct company, the correct product, and then if you're looking towards and the reason why I keep saying IUL or the index is that's been really the go-to more recently, because individuals want to have this peace of mind of saying, I want to have good growth onto my account, but I also want to make sure that the market's crashing, I'm not being susceptible to, like I would with a variable universal life. I want to make sure that, it's at least giving me a 0% floor. So, what sort of index, the type of index, is it an S&P 500 index, which is a very common one, or do you have these nice little nuances to the S&P 500 index where you could have a higher growth potential and algorithmic indexes that are built in there, so that were times during volatility, like we've been experiencing the last couple of years, that they've really been doing well, uncapped indexes versus cap related indexes, things that will allow your account value and really the longevity of your account to really capture those double digit rates of return in a given year and translate into a good growth rate throughout the life of your account, of your contract. The fifth most important part is how it's designed and structured, and that's what I was, alluding to in this first section in the conceptual understanding. But be mindful, there's a bunch of different nuances. There's ways on how you can have a third party pay for your cost of your different expenses the longer that you're in the plan. Some have some sort of expense reimbursement structures that are created in there. So it really depends upon what your situation is, how long you're looking to leverage this, and which portion of dollars you're looking to place in there. And what sort of result that you're trying to get out of this. So obviously you want to make sure it's designed and structured the right way. The sixth aspect is making sure it's funded the correct way. Do you want to pay monthly premiums? Do you want to pay annual premiums? Do you want to throw lump sums and do a 5-pay test where you're trying to leverage it for 5 years? You're taking lump sum dollars and you're trying to max fund this for 5 years and then never place another premium dollar in there. Another thing would be if somebody is, let's say, in their 30s, their 40s, and they want to utilize this as a type of retirement strategy, retirement supplemental strategy, and say, okay, I'm going to go place this money in here, but then at age 65, I never want to put another dollar into this plan. So it has to really look at how much money is going to go into this plan and then scale backwards off of the frequency of payments in there to make sure that it's set up properly with the correct carrier. And lastly, you want to use the policy correctly. If you're trying to set up a max death benefit play and you're saying, oh, well, I should just go into a whole life insurance product because it's going to give me, a death benefit that's going to last there for my entire life. Well, it might be more beneficial to leverage a GUL, a guaranteed universal life, that will be significantly cheaper than a whole life insurance policy, but still give you that death benefit. Think of it like an umbrella over your head until you're age 121. So something that realistically you're never going to outlive, so that if you pass away at your age 90, if you pass away at your age 105, 110, whatever that is, you would still be, that death benefit will still be intact and will still get paid out to beneficiaries, but was able to save you thousands of dollars in the process by leveraging that sort of concept versus, something that if you want to set up for a max cash value play, making sure that you're using the policy correctly, and it all comes down to your situation and how you're going to use, what you want the sort of account, the sort of plan to do for you, what sort of benefits that you want it to really be leveraged for your retirement situation or for your retirement goal. So I hope that all this information, makes sense. Lastly, what is the solution? How do you know whether or not this might be something for your situation? And then how do you, make sure that you're not making those common mistakes? And it all comes down to what you're trying to create. Are you trying to use this and the cash value plan, a type of life insurance policy that builds up cash value? Are you trying to utilize that as a retirement supplement? Do you make too much money to place into a Roth IRA or a Roth 401k that you might not have access to through your employer? What's their ways on how you could grow monies tax-free, make sure it's in that tax-free chassis, and then pull those monies out properly? Do you want to take those monies out in the form of withdrawals or policy loans or 1035 exchanges, when you do get to that ideal retirement date? So it really depends upon your situation. What we do is we fixate on a trademark process known as the retirement diet plan, and we're looking underneath the hood off of somebody's situation. First off, understanding what their current budgeting analysis is, what types of monies that they want to fund this properly, what type of monies do they need to take distributions from, and make sure that they're correlating to from their expense analysis when it does come time for retirement, where they're no longer going to be placing monies into this plan. How do they leverage this plan, for their benefit? So from a D, so basically the retirement diet plan stands for distribution, investment/growth planning, estate/legacy planning, and then T, taxes. So distribution, investment, estate, and tax. How do you make sure that that is correlated if you're trying to utilize this sort of account? The distribution play, trying to figure out how much income you need in retirement. So from your point A right now to point B, your retirement date, would this be a viable solution? And what is the top carrier to utilize and the top structure to utilize with this sort of plan? When you're saying in the diet plan for growth, are you just trying to build up, just have another asset that's working for your advantage that you could always pull monies from in a tax-free manner, but maybe you might not have to rely on that sort of, cash value component? The E, obviously it's life insurance. You're going to have, if you set it up properly, you're going to have a tax-free death benefit that's set up with this sort of plan. So for estate planning purposes, this could be very effective. For a legacy, if you say, hey, I want to make sure that I'm leaving a legacy to my loved ones, I want to make sure I'm using the correct policy with this. It might not be a cash value. It might be something that doesn't build cash value, such as the GUL that I mentioned previously, or a type of whole life where you want to kind of have a little bit of, guaranteed death benefit, but then also have a little bit of a guarantee on a cash value side. And then the T is taxation, which I mentioned over here. You could have very favorability, a large favorability with benefits, with tax benefits, tax-free growth, tax-free income, tax-free death benefit, and then also leveraging the sort of plan for ancillary benefits, for a type of long-term care play, a type of disability play, et cetera, et cetera. So I hope that all this information made sense. If you found value in this video and you'd like to speak to a specialist, feel free to give our 1-800 number a call. It's 1-800-566-1002. We're available 24 hours a day, 7 days a week. When calling in, just basically reference this video and say, I'd like to speak to a specialist, further about this and see if it might be, ideal for my situation. And then we'll make sure to set something up. The other way you could do this is by going directly to our website, afasifinancial.com or retiresharp.com. And you could look at our process, look how everything works with when you set up a phone consultation or a Zoom consultation. Obviously, in this post-COVID era, we want to be as safe as possible, and making sure that you could deal with an appointment through the comfort of your own home. But you would be able to schedule a calendar appointment where you could scroll down to the bottom and or you'll have a, obviously our digital calendar will pop up on your screen when you're on the website for an allotted amount of time. So in closing, I did hope that you found value in this video. Feel free to subscribe to our YouTube channel, Retire Sharp, so you could have access to the most updated videos. I'm going to try to update these videos, a few times throughout the week, just so that you have the most fresh content, especially what's happening out with our current economic environment. And really look forward to helping out with your guys' situation. Thanks so much.